Hello, and welcome to Macro Minutes. During each episode, we'll be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures. Hi, everyone, and welcome to this edition of Macro Minutes called To Hike or Not? That is the question, which we're recording on April 15th, 2026. I'm Jason Daw, the head of North America Rate Strategy and your host for today's call. So market pricing for central bank policy rates has been on a wild ride recently. Front-end yields, they spiked to extreme levels during the initial phase of the oil shock. They are lower now, but in some countries painting a very different picture than where we were before the war started. Now, policy responses, they're not going to be uniform across countries, but some central banks might be inclined to move preemptively, while others could wait a lot longer. So in this episode, I'm joined by Gwinn, the head of U.S. Rate Strategy, and Peter Schaffrik, the head of UK and European Economics and Rate Strategy. And we're going to unpack the outlook for central banks. So let's get right into it on the U.S. side. So Blake, what's your take on the Fed at the moment with everything going on macro-wise and with elevated oil?
Yeah, so Jason, I guess, first kind of dealing with the Iran impacts, maybe talking about the Fed a little bit more broadly. But, I do think this basically helps to keep them frozen in place for the time being. It's long been our call that they are not going to cut for the remainder of 2026. And like I said, I think this just reinforces that call. The likelihood of this Iran conflict getting drawn out, the possibility of lasting price impacts, I do think that has removed some of the risk of them cutting. And definitely, if there were some doves who had thought about a few more cuts anytime in the near term, those are definitely put on hold. I would say longer term, I lean a little bit more towards the dovish impacts of a prolonged Iran war, just meaning that if we do see prices rising, that's going to drag on consumers, drag on businesses in a way that if you look kind of over the longer term, it is more likely, in my view, to end up in cuts to deal with that demand destruction rather than hikes. But at least for now, what I think it does is really keep the Fed on hold. But even if you strip away all the Iran impacts, I still think the last month or two has kind of reinforced our view for the Fed on hold for the rest of this year. And what I mean by that is the Fed is still dealing with a bit of a sticky inflation problem. Goods are probably being impacted a bit more by tariffs than they had expected at this point. If you had asked them for, if you'd asked most of the committee members 4 or 5 months ago, I think that impact that we've seen, even though light, still a bit more than they were probably pricing in. We have seen some stickiness in core services ex shelter, particularly December, January figures were a bit elevated. You've heard Powell and some of the others kind of flag that pressure in a bit of a hawkish tone. They probably got a little bit of relief in the last few prints. The February print didn't look particularly bad. And then in March, that stepped down by a decent amount. So it gives them a little bit of breathing room there. But I still think, we are seeing year-over-year numbers that are not comfortable in terms of their 2% target and something that they still have to keep an eye on, even with that little bit of relief that came from the March inflation prints. At the same time, the case for cuts has really eroded, I think, in the last few months. We've seen continued stabilization of labor markets. One of our reasons for not having cuts baked in is that we thought some of that labor market fear of late last year would start to fade into this year, and that really we were just seeing kind of a realignment of how the data was coming in with some of the supply shifts in the labor market, and that markets would kind of normalize around that. And we have seen that. I think, we didn't see labor markets tipping into nonlinear deterioration like some of the Fed were worried about. And I think really now you just have one or two doves who are still kind of probably overly worried about labor markets. I think for the most part, the majority of the committee is probably thinking things are at a pretty stable point. So again, just reinforcing that idea they're on hold for the year, and we don't really have cuts coming until 2027 as inflation comes more sustainably back towards 2%.
Good take, Blake. As always, if I may, if you zoom out a bit further out the curve, where do you see interest rates, all things considered?
Yeah, so near term, I think it's hard to say that Iran headlines aren't going to be the biggest risk for vol in rate markets. We're still kind of just shopping around with those headlines going back and forth every day. But I do think what we've seen over the last few weeks is that yields beta to those headlines, or really the impact that those headlines and the back and forth of news flow every day is having on yields, that does seem to be fading. And that's really something we've seen in the past, not just in the current Trump administration, but in his past administration, where you would have these kind of big shocks as a new, whether it was opening up the trade war with China back in 2019, whether we're talking Liberation Day last year, you see big initial shocks, big reactions to headlines, and then over time, the impact of the back and forth, the negotiations on tariffs, et cetera. Markets just start to care less about those things, and I think we've kind of entered that phase with Iran, where these back and forth on ceasefires and stuff, they're just really not having as big of a yield impact. So I do think that's fading, but something we at least have to keep in mind in the near term. And I do think we're cautiously optimistic that we have already seen kind of the peak of Iran angst in yield markets. So that's I'm mostly talking about the highs in yields that we saw in late March. Now, you might take a look at what I just said and say, oh, you must be pretty bullish here, but it's not that either. And I think what our base case is at this point is we're really heading back into a more range-bound environment into the summer. Reasons for not being particularly bullish, I think a lot of the easy lifting on the retracement of that March sell-off has already happened. The small rally we've had off of those yield highs, that was kind of the easy part of the correction. And now that seems to have stabilized. And we've seen some resistance, as 10s kind of got down to that 430 level, et cetera. We have seen some support there. You've got the Fed back firmly in wait and see mode. They have not taken the bait on chasing hawkishness around the Iran headlines. So they're firmly in wait and see. Like I said, you're seeing that kind of fading of impact from Iran headlines. And I do think, if you just look at where we're priced for the Fed, it does look relatively fair at these levels as we've pulled back from those late March levels where we were actually looking at hikes. So, I think the other thing is, when we look back at some of these past bearish realignments, they don't just disappear. They don't just retrace when those catalysts start to fade. I think, even if we are on some path to normalization around Iran or path to de-escalation, it's really going to take a new negative catalyst. It's going to take a new catalyst to push yields back to kind of pre-Iran levels. So I think we're just kind of stuck in these current ranges for now. I don't really have strong convictions on a directional lean, at least in the next month or two. Now, as we get later in the year and we start to, see inflation more sustainably come back down, and we start thinking about those cuts we have forecast in 2027, that's where we have a little bit more yield decline, a little bit more of a bullish view. But at least in the near term, I think we're in for, a month or two into the early summer of range-bound trading. So, Peter, why don't I kind of turn things around? Let's talk about your end of things for a little while. I think it's pretty safe to say that there was a lot more angst in Europe. I think just comparatively what I was looking at and what we were seeing in the U.S., as much as we did move, it was really kind of nothing compared to what we were seeing in Europe around the energy price spike. We've seen a pretty sharp repricing, both in terms of Euro, but also UK. So how are the ECB and BOE thinking around the situation as compared to the Fed?
Yeah, thanks, Blake. Let me take the first part of the question first. Yes, there was a lot of angst, and I think the reason for that, in my mind, has many origins. So the first one is we're net energy importer. So anytime energy prices go up, that's a negative terms of trade shock for us. That's bad. Secondly, it's not too long ago that we had a significant price shock in the form of the Ukraine war that is lingering in the background for sure. And also we have relatively large industrial bases, Germany, northern part of Italy, parts of the Netherlands, France, who are quite reliant on relatively cheap energy. And that obviously caused a little bit of angst. Having said that, maybe last point before I quickly go to the central banks, what's also clear is that the nature of the shock is slightly different. It's more related to oil and derivatives of oil rather than gas. Gas is very important here in Europe. It drives power prices. That was the big thing in 2022. Is less impacted now. So I do think there are nuances. But as far as the central banks are concerned, look, first and foremost, they are more hawkish for sure. Just like you said with the Fed, we were pricing rate cuts for the Bank of England, for instance. They've gone out of the window for now. Maybe the Bank of England was not expecting as much hawkishness in the market as they were trying to convey, but it's very clear that they're not going to cut anytime soon. Now, the backdrop to 2022 also matters here because both of them were, after the energy price shock of 22, accused of being too much behind the curve when they were trying to look through it and then ultimately found out they couldn't. And they have very clearly said that they don't want to do that mistake again. On the other hand, and that's probably where I'm closing, they're terrified of making, let's say, a tree-share move where you hike now into a what is clearly also, to some degree at least, demand-destructive environment, just to reverse course. So as they don't know where the chips will ultimately land, I think for the time being they will try to buy some time, but clearly have adopted a more hawkish bias.
Yeah, so Peter, you kind of mentioned these impacts we're seeing not just in energy, but kind of second derivative products as well. So, I mean, how do you think that the economies you cover are going to react to those shocks? Like, what's the most likely scenario here?
So look, I mean, before I answer that question directly, I think it's important to take a step back. Where did we come from when we went into the crisis? We had low unemployment, we have relatively low productivity growth, and that, in my mind, makes us relatively inflation prone. The ECB was probably biased towards hiking rates, or at least not cutting rates anymore. And against that backdrop, I think it's very clear that the inflation impact is something that they will watch very, very carefully. Equally, the Bank of England, even though the economy was weaker, they were quite hawkish beforehand, even in the cutting cycle, as paradoxically as that sounds. So the big question now is not only will there be an inflation shock? Yes, of course there will be an inflation shock, but how can the economy react in order to prevent second and third round effects that we clearly saw in 2022. And I think that will ultimately also be then what the central banks will react to. They have said very clearly that they would like to look through the first round effects, but if the economy is too tight, so to speak, to prevent second and third round effects, then I think the central banks will react to it.
Yeah, let me jump in here, Peter. So you put out a note recently discussing where yields might head, specifically related to near-term central bank meetings. Can you summarize what you're thinking here?
Yes, thank you, Jason. I think that's an absolutely crucial point in my mind when we look at the market now. So the way the market has priced this is that we will see relatively quick action from the central banks over here in Europe, and particularly the ECB, for all the reasons I just outlined, tight economy to begin with, the response to 22, or the lack of response at the time, and all of these things. So the market has now clearly said, oh, this time around is going to be different. Now, frankly, I disagree with that a bit. I think they will try to buy some time. Now, we also put a note out, a different note that you just mentioned, where we said if push comes to shove, if they have to pick a poison, they will go against inflation and will hike, but they want to be quite sure that this is the right path. They want to make sure that they avoid, as much as they can, a policy mistake. And that means buying some time. So in my mind, the next meeting in April is almost excluded that they will go. If I look at the June meeting, which is then the next one, the market is implying a full 25 basis point rate hike as well. That is possible, but is not guaranteed. And that's also what we heard from some of the central bank speakers so far. So if anything, I would argue later rather than earlier, even though the bias towards higher rates, particularly for the ECB, less so for the Bank of England, but particularly for the ECB, in my mind, is relatively clear, but certainly not in the near term. Well, Jason, let me turn the tables here as well and turn the picture to the Bank of Canada. It has one of the most dovish messages of all central banks, certainly last week. What do you think? Is that justified, given the importance of the energy sector for Canada in particular?
Yeah, thanks, Peter. The Bank of Canada's message was definitely more dovish, especially versus what we heard from the Bank of England and the ECB kind of in the same week. They're obviously worried about inflation risks, but they haven't materialized outside of headline inflation now, obviously. But they did sound dovish on the kind of growth environment. And I would break down what they said into kind of three key things, paraphrasing. They have patience. They have a long runway before they would need to act. They will need to see some clear evidence of second round impacts starting to happen from oil prices before they'd be willing to do something. And, they could have had an easing bias if it wasn't for the oil shock, in our opinion. Now, the energy sector is definitely interesting in the context of Canada. We're a big net energy exporter, and I think when people think about Canada, they believe that it should be, very growth positive when we get an oil shock like this. The reality, though, is somewhat different. The real trade balance hasn't really moved all that much in the past 5 to 6 years. We are export constrained as far as capacity to some extent. So higher prices don't necessarily translate into higher volumes. There is going to be some benefit the economy sees through corporate profits being higher on a nominal basis, government revenues being better from a corporate taxation standpoint or from a government royalty perspective. But, on the flip side, business investment has not been responsive to higher oil prices over the past decade. And the consumer could get hurt a little bit. But that has been offset with some fiscal measures as far as reductions or a holiday in the federal excise tax. So overall, the GDP impact from higher oil could be neutral, could be a small positive, could be a small negative. Probably not a game changer at current levels. I think the big risk is if we go a lot higher in oil and if those higher prices are sustained, then that might become more growth negative.
Jason, let me ask you a follow-up, and I'm deliberately changing tack a bit. I know that you're tracking the flow data that we're seeing in the Canadian market, and obviously we had very large yield moves over the last 6 weeks or so since the war broke out. So what is your flow data telling you, and what are our clients doing generally?
Yeah, so, obviously during this period, in the initial phase of the oil shock, yields went up a lot. So the market, must have been selling on average. Yields have come down, a decent amount from the peak of where we were a couple weeks ago. But what we've seen from our client base is a pretty healthy demand for duration, particularly in the front end of the curve. So there's been a lot of interest to fade the hikes that have been priced into the market to earn some favorable carry in the front end of the curve around the 2-year sector. And over the past 5 weeks, we have seen modest demand in the 10-year part of the curve. So overall, when I look at the big picture aspect of what's happening, some of the more active medium-term investors, have believed that the level of yields that we reached a few weeks ago and even where we are now are attractive entry points for medium-term exposure into Canadian duration.
So, Jason, looks like we have time for one more question. With the cross currents you're seeing impacting the economy, you've got tariffs, USMCA, population growth changes in Canada, and now all of this kind of oil noise. How do you see monetary policy evolving for the BoC?
Yeah, I think, importantly, all the factors that are affecting Canada right now, at least the big ones, as you mentioned, tariffs, USMCA, population growth, and oil, these are all kind of supply side, structural shocks in nature. And monetary policy is not well suited to handle these. Fiscal is much more appropriate. We've seen a little bit of action from the federal government. There could be more in the future. That's definitely an easier avenue to smooth some of the issues that we're facing. Now, I think when you think about where we are from a starting point in the economy, because that does matter, the starting position is one of excess supply. We see that both in the product market and the labor market to some extent. And over the past few months, core CPI has been very, very soft. So at least from the bank's perspective, the starting point for the economy affords them the opportunity to wait, to have patience, and gives them a long runway before they need to do something, at least in relation to what's happening with oil prices. Now, our overall view on the Bank of Canada hasn't changed for the past 6 to 9 months. We've thought from a base case that they're on hold in 2026. They could start raising interest rates in 2027. And when we think about the risks between rate hikes coming earlier in the second half of this year compared to possible rate cuts, which you'd have to have oil fall for that to be a viable policy outcome. But, the risk between hikes later this year or cuts this year, we still think that is skewed to hikes being more likely than cuts. So, yeah, again, base case are on hold. There should be some risk premia for hikes in the market. If the market's pricing one hike by the end of the year, that's probably fair. If it's pricing three, that's probably too much. And if oil went back down anywhere close to the levels before the situation with Iran, then the market could easily take out any rate hikes from the market and go back to pricing a small chance of rate cuts. Thank you to our listeners for joining this episode of Macro Minutes. Policy rate expectations could swing around quite a bit over the course of the next few months and cause associated moves in the level of yields and the shape of the curve. So please reach out to us directly or via your RBC sales representative for any follow-ups.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.